Hey, what's up, everybody? It is Thursday, September 15th. September 15th! I've been warning about this day for, 3 months. And we're down today. Actually, I have to say that the magnitude of the drop today, not that bad, but when you take into account, what was it, Monday or Tuesday, that huge drop, and it's been quite a correction. But like I warned, going all the way back to June, I said when we get to September 15th, that's going to be a quarterly corporate tax payment. It is going to be a sizable fiscal drain. So let me give you some numbers. I think the best way to understand this is if we look at the monthly, where the deficit is. So on September 8th, what was that? Last Thursday, we peaked, the deficit for September on September 8th peaked at 92 billion. So now you should know what that means. What is a deficit? It means the deficit of the government equals the net addition to the financial balances of the non-government, the economy. The swimming pool going up, that's filling up the level, okay? So 92 billion, we peaked out September 8th, last Thursday. As of yesterday, yesterday we had a pretty big drain. We had almost an 18 billion drain. Today was the big one, but we'll see the number on that tomorrow. But as of yesterday, the deficit had fallen to 54 billion. Still a deficit, but like the swimming pool water was at 92, right? And it just got drained down to 54. So almost a 40 billion, almost half, has been drained out. So now you could kind of understand, without those balances being added, and even more important, the fact that these balances are being drained, the market's coming down. Right? All this stuff is very, very understandable. There's nothing, crazy or outlandish about it. It's just, these flows, I've been telling you for so long, these flows drive conditions. A lot of people look at, I've said this so many times, they look at the economic data that the government puts out, but all that stuff is second derivative stuff. The first derivative, the core driver, the core fundamental, is going to be these flows. That's why I look at them. And then I could have a very good forecast or estimation of what the second derivative and the third derivative data is going to look like. No problem. So we're down 40 billion since last Thursday. And I think, like, when we see today's numbers, we'll get that in the daily Treasury statement tomorrow, the government's balance is probably in a surplus, which means that all the water from the pool has been drained out, and then some. Like, there's a hole in the bottom, and it's not just the water going out, but it went way out. Government's balance is up. So it's going to take some time. That's the thing. It's not necessary to panic, not necessary to, get all crazy about this stuff, because we know that the government runs deficits. I mean, this is just the how can I say it? It's just, that's our fundamental situation. I mean, the government runs deficits, and that's not going to go away unless there is policy like what Clinton did in the mid-90s to say, okay, we're going to end that. But that's not going to happen. Okay, I'm telling you right now, that's not going to happen, because in order for that to happen, you'd have to see major cuts to the big four. I call it the big four. That's Social Security, Medicare, Medicaid, and defense. Defense, you know, right away is never going to get cut. I mean, neither the Democrats and for sure the Republicans are never going to cut defense. They're never, ever going to cut defense. If anything, they're going to add to it. Social Security, you know, that always comes up as a potential, but they call that the third rail of politics, meaning any politician who touches that or tries to mess with that, you know, they're going to have problems. They're not going to get elected or whatever. But that doesn't put it outside the realm of possibility. I mean, even the Democrats, I remember, you know, Clinton and even Obama, you know, the Democrats have spoken about doing that in the past. And the Republicans absolutely want to do that. So that's, I'm not saying that's something near term. But anyway, those are the four things: Social Security, Medicare, Medicaid, defense. The only way to run a balanced budget or a surplus perennially, in other words, like for annual, for the year, would be if those things got cut. So we're not even, that's not even on the table for discussion. So getting back to my point, don't freak out about this drain. Okay, because it's a temporary situation. Just like what we had in April and just like what we had in June. And I was telling you guys, like, yeah, it's you know, it's negative now for the moment, I was saying back then, but spending will replenish what has been drained out. Same thing going to happen now. The spending, and I've given you a date even. All right, just like I gave you September 16th, way back in June, I said by October 6th, the balances will be put back in. In other words, the pool will be filled back up again. Maybe a little bit sooner, maybe a couple of days later, but in general, what I've seen when it comes to these quarterly corporate tax payments, it takes about 3 weeks of spending to replenish those balances that were sucked out. But in the meantime, we got a market that, you know, could, you know, I think would like to rally. Okay, we saw some good economic news today. We saw weekly unemployment claims dip way down to the lowest levels. So the non-seasonally adjusted dipped down to the lowest level since 1953. And the seasonally adjusted has dropped 30,000 claims in the last month. So that was good. And retail sales were strong. They were up 0.3%. That was more than what was expected. So the economic numbers, they're okay. The other thing I'll mention is that the leading spending flows, the daily spending flows, that's like, you know, the leading flows, what the government spends before taxes, you know, take some of that away. They're starting to accelerate higher. Now that's a really good sign. That's a really good sign because we haven't seen that since like early May. So that's a really good sign. So it says to me that as soon as we get through this drain, this tax drain, you know, we're going to be on better footing. It's going to be a better picture. It's going to be it's going to be a bullish picture, simply stated. So I hope right now you're starting to see how important and how valid as a tool looking at these flows are. One thing I want to talk about, if you watch or read financial journalism, CNBC, Wall Street Journal, I mean, I'm just going to put it straight to you. You are getting stupid. You are not getting informed. You are not getting educated. You know, you're getting stupid. Now, there was an article today in the Wall Street Journal. I just happened to see it online. I don't subscribe to the Wall Street Journal. I don't read the Wall Street Journal. I think it's junk. I think it's garbage. I don't read any, financial media or journalism that's out there in the mainstream because it's garbage, really garbage, and, it just makes you stupid. But today there was a big headline I saw that said, bank deposits are dropping dramatically. And then underneath that it says the Fed rate hikes are causing bank deposits to go down. And when I saw that, I was just like, this is absolutely idiotic. Rate adjustments have no correlation to bank deposits. As a matter of fact, bank deposits, they can't go anywhere. They can only be drained in 3 ways, all right? And 2 of those ways are temporary, and one of those ways is like a kind of an artificial construct that the Fed created, okay? There's only 3 ways you could drain bank deposits. And, none of those ways has to do with rate adjustments, okay? So the first way is taxation. When the government taxes you, we're feeling that now. You got to send a check to the government, to the Treasury, and that goes out of your account, and that's it. It's just sucked out. It doesn't show up anywhere else in the banking system. It's gone. It goes into a black hole, okay? That's one way. The next way, number 2, is when the government sells securities, when they sell bonds, when they sell T-bills, when they sell notes, stuff like that. So that's an exchange. Your balances, deposits are sucked out, but they're replaced with a government security, which is essentially, a dollar alternate, all right? So that's the second way. The third way I'm going to mention in a minute. But of those 2 ways I just mentioned, now listen to me very closely. Okay, taxation and the sale of government securities, those things can drain deposits. But, listen, as the government spends, it replaces that drain. Okay? So like I just talked about with the taxes, the corporate taxes, yes, it's a drain, but the normal course of government spending will replace those drained balances. Same thing with the sale of government securities. When the government sells securities, okay, and it drains deposits, the normal course of government spending, because the government spends, deficit spends, right? It spends more than it takes away in taxes. The normal course of spending will replenish that drain. So of the 2 ways I just described where deposits can be drained, that drain is temporary. Now I said there's a third way, and it was like a construct, something created by the Fed. And this is where it gets kind of funny and comical, because first of all, the Wall Street Journal didn't mention anything about the 2 things I just told you, which are, 2 actual ways that deposits could get drained. They can't get drained from rate hikes. It's stupid. The third way, remember now, what did the Fed create? What was it like not last March, March 2021. What did they create? They created that reverse repo facility. Why did they create that? Because deposits and bank reserves were building up to the point where banks were, at risk of violating the Fed's leverage ratios. Because of the Fed's stupid quantitative easing, the Fed was dumping trillions of dollars of reserves onto the banking system. The banks couldn't hold them anymore. Otherwise, they had to raise capital or they had to stop lending. So the Fed created this facility, the reverse repo facility, so that the banks could stick the deposits over there, okay? And they're kind of like they're taken out of the system, but they're sitting on the Fed's books. And that's exactly what happened. So like when the Wall Street Journal said, oh my God, deposits fell 380 billion from the end of March until June. Well, guess where they went, folks? They went to the Fed's reverse repo facility. They're all there, and then some. The reverse repo facility is up in that amount of time by 400 billion. So all those deposits that the Wall Street Journal was freaking out about and trying to make a case that it was because of the rate hikes, they're all there, the deposits. They just went to that facility. Why did they do that? Because the banks don't even want those deposits. Again, it puts them up against that threshold of being in non-compliance with the leverage ratio. Now, the point I'm making here, and I hope you learned something from this, but the bigger point is that don't listen to the Wall Street Journal. Don't listen to CNBC. They're idiots. They don't know what they're talking about. They're just making up some garbage to, kind of support their narrative that this horrible, terrible interest rate thing, oh my God, it's sucking out deposits. It's not sucking out deposits. They're all there. They just moved into that facility because the banks don't even want them. Makes me nuts. So yeah, that's what's going on, and everything's okay. We got to get through this drain. I've told you about this drain. Now I was hopeful, and I'll be honest with you here. And you could call me out on this. Like a couple of weeks ago, when we were in August, and we had that sell-off from Powell's, 8-minute speech about I'm going to give you pain. And we had a big, that was a big week down. I said, I think some of that selling is front running ahead of this tax payment. And it looks like if it was not all of it, unfortunately. And now we're feeling it. So I think, we're going to see some weakness. Next week is the Fed meeting. They're going to raise 75 basis points. They're going to talk really, really hawkish and tough. And the monetarist zombies are going to sell. But what I want you to focus on now, two things. October 6th, when this drain will be replenished, and the fact that these leading spending flows are accelerating for the first time since May. That's good. Anyway, that's it for today, folks. Got all worked up. I gotta go get a drink of water or something. All right, everyone. Have a good one. See you tomorrow. Bye.